Gold miners have widely outperformed energy stocks this year as the price of the precious metal has hit new record highs. So, we're pretty close to 2026 kicking off. Will that trend continue into that new year? Joining us now to discuss is Andrei Yastreb, VP for Portfolio Research with TD Asset Management. Great to have you back on the program.
Thank you for having me.
We got a few things happening in the commodity space. Let's start with maybe what's not been working this year, oil and gas and some of the energy names. You got some charts showing these interesting divergences we're seeing. Walk us through it.
So if you look at this chart, what it shows is interesting divergence between the commodity oil, which is down about 15% year to date, versus TSX and S&P energy sectors, which are up, which is very unusual, right? Usually commodity stocks follow the commodity. This year it's been quite different. I think there are some fundamental reasons why you could make sense of that and say that companies are in better position than they used to be. They have less debt, they reduce costs, they're generating free cash flow, buying back stock. And in Canada specifically, we have benefit of TMX. So our WCS differential, the price at which we sell our heavy oil, is at a smaller discount than it used to be. But all of that, I think, what it really shows is that investors start to believe that this oversupply that we've been talking about this whole year in oil market, that it's temporary, that it's not going to last, and basically trying to look through that. I think that it might be a bit too early to do that. If you look at data and the details of the data in inventory specifically, in oil, oil and water increased since mid-August by about 260 million barrels. That means roughly 2.5 million barrels increase per day. So like if you look at the magnitude of the increase we've had so far this year, or literally the last four months or so, that is very comparable to COVID. So from here, it's hard to tell where oil will go, but it looks like we are in oversupply. And what we know about 2026, we know that OPEC is not changing their plans. Other producers are increasing production, and demand has been strong. It's been resilient, but it's not necessarily accelerating. So I'm still bearish on oil, and that the divergence of energy equities versus oil is notable because potentially that could signal more downside for energy stocks.
It's a lot of oil and tankers out there on the high seas. All right, so oil has been challenged by that really interesting divergence there. We've seen the big rally in gold, though. That has really captured everyone's attention. You have a couple of charts showing us how that's impacted some of the gold equities.
Yeah, so I wanted to connect it to fundamentals and compare energy versus gold. So on the first chart, if you look at the free cash flow change for both industries, and what I did is that I took free cash flow. This chart shows something different. This one shows okay, that's the right chart.
There we go. Now we're on track.
So if you look at this chart, I took quarterly free cash flows for both industries into 2024, took an average and looked at how it changed from that baseline over 2025, and also what the consensus expects for Q4 of this year and Q1 next year. And as you can see, even though oil has been in a down kind of trend since 2024, free cash flow generated by energy companies has been roughly flattish. Maybe there's a bit of downside or ups and downs, but roughly flat. And maybe that explains part of the resilience in stocks. But if you compare it to gold, it's completely different.
That does not look flat to me.
No, so gold free cash flow versus 2024 average for Q3 was 2.4 times higher. And then if you look at consensus expects that between Q3 and Q1 of next year, which is basically 6 months, it will increase by another 50% roughly. The other interesting part is that when you think about the fundamentals here, right? So for oil in 2023, oil was $82 per barrel on average. Then in 24 it was 80. This year we're at 69 and probably going lower for next year. For gold, it was completely opposite, right? We had a big run in gold. And if you look at Q4 numbers just relative to Q3, we have $600 per ounce increase in average price so far this quarter. So we know that a big chunk of that increase that markets are expecting is already reflected in the price.
Let's talk about then what could happen to that big run in gold, because that becomes a question with us so close to 2026. Can it continue? You're taking a look at some of the fundamentals here. Walk us through this.
Yeah, so this other chart looks at the free cash flow yield, right? So we were talking about how free cash flow changed for the two industries over time, and this one is looking at free cash flow yield. So the interesting part here is that if you look at oil, green and blue lines, the energy stocks. If we went back in time 2 years ago, oil was at $80 and these companies were generating free cash flow yields at 12, 14, 15%. That was really attractive. They were making a lot of money and they were, the stocks were not that expensive, providing you high yield. Right now, that yield reduced to 7.5%. So some of that stock outperformance was just the yield compression, right? Or you can think about it in terms of multiples. Multiples expanded. So investors are willing to pay more for the same energy stocks than they used to, which is not as attractive entry point if you think that commodity itself will be going down. And for gold, that golden line there, it's completely opposite. A couple of years ago, you get probably 3% free cash flow yield if you invest in gold stocks. Now it's 7.5% matching energy stocks. And as we mentioned before, if you look at the forecast and how gold price increased already in Q4 versus Q3 and year on year, that probably continues to go higher. So from kind of investor psychology perspective, you could say that the investors think that the weakness in oil price will not last, and they're willing to accept lower yields on energy stocks. At the same time, they don't expect this boom in gold prices to last, and they're paying want a somewhat higher free cash flow yield in gold miners.
I think you have another picture for us, and I'm curious to see this. I haven't seen it yet. Microsoft versus U.S. Treasuries chart. What story is this telling us?
So this one is going back to fundamentals on gold and whether gold is stretched here or there's a fundamental story behind it. And it's unusual for equity or commodity analysts to look at fixed income, but I think this tells a real story of why gold is where it is and why it might stay here. So this chart compares spread between Microsoft February to 2027 bond and the corresponding Treasury bond. And the spread, historically, when you think about it, it's just a measure of risk, right? How much more return investors are willing to accept or want to accept to invest in a corporate bond versus a Treasury.
We think of Treasury as the risk-free rate.
Exactly. Right? So that's how we were always trained, right? The Treasury is risk-free, corporates are risky, and you need to be compensated for risk. If you look at that green line, which is simple G spread, just a simple spread between the two, that spread is negative, -3 bips, which technically tells you that the investors think that Treasuries are more risky than Microsoft.
Wow.
And I've seen some kind of media comments in that vein as well, but the trick here is that if you look at the details of the bond, that specific bond has an option. So Microsoft has an option to call it early. And that yellow line is an option-adjusted spread. So it takes that optionality into account. So from that perspective, it's still a positive spread. So nothing, we haven't gone to the crazy levels yet in terms of US government being more risky than Microsoft. But when I charted it and looked at the chart over last year, what the interesting part to me is that if you look at the yellow line, it's the lowest level for the whole year. So we had the trade war, we had Liberation Day with a lot of volatility, we had a lot of other things happening in the market, and yet just now that spread compressed to its lowest level, which tells me that there is a real concern among investors about U.S. debt, U.S. budget deficit, how all of that will play out over coming years and decades. And from that perspective, they're looking for alternatives to holding treasuries. So high quality bonds of corporates like Microsoft is one alternative, and gold is obviously another safe haven alternative. And from that perspective, I think as long as those concerns don't go away, and I'm not a specialist in sovereign risk or U.S. treasuries, but I just don't see how we get out of that problem with debt to GDP being so high and budget deficit being so elevated. We've seen some efforts this year with Doji and all the plans from Trump administration, but we're not even hearing that anymore, right? So from that perspective, I think market is reassessing the riskiness of U.S. government, but also other developed market, and thinking about the bonds investments there and trying to diversify away from that. And that benefits gold.